Hi everyone, this is Eric from Traders Helping Traders, and in this video we're going to discuss the use of RSI as a secondary indicator. I don't like to use a lot of secondary indicators because the abundance of secondary indicators has a tendency to just end up clouding your judgment, giving you too much information and leaving you unable to make a trading decision. However, RSI I have found to be a fairly useful secondary indicator. Probably because RSI is such a popular indicator, it gives me an insight into what other traders are thinking. Now there's several ways that you can use RSI. RSI, as most oscillating type indicators, has an overbought and an oversold region. The idea is that once the market is in the overbought region, it will find resistance, and once it is in the oversold region, it will find support. This is true most of the time. However, oftentimes, and depending on the market you're trading, RSI can spend a relatively long period of time either overbought or oversold without really going anywhere. This is the December cotton chart, and you can see here that for the last couple of weeks the market has been oversold. It's found support, but it hasn't really rallied off of support. And previous to that, the market was overbought, and it eventually formed resistance and declined, but not after being overbought for at least a couple of weeks. The traditional settings for the overbought and oversold region for RSI are 70% and 30%. I also like to run a 50% line through the chart because that shows me where the market is neutral. You can see that sometimes RSI will bounce off of the 50% level, and it will have a tendency to act as support or resistance on its own. If the RSI indicator is approaching the 50% level, I might anticipate a bounce near that level, and therefore I would look for a corresponding resistance or support level to form on the price bars. I use the traditional 14 period setting for RSI. However, other popular settings are 5 periods, 7 periods, 9 periods, and 21 periods. Those are the most popular settings besides the 14 period, which is the standard. I find that the faster settings actually give me too many signals, whereas either 14 or 21 usually works out the best. 21, unfortunately, because it takes into account a longer time frame, often will not get into the overbought or oversold region. But perhaps my favorite way of using this indicator is to find what I call test points. And test points are merely trendline reactions. So what I would do in an instance like we see here in December cotton, we have a market that has been in a bit of a downtrend. We can tell this quite easily just by looking at the chart. I would take the peaks on the RSI indicator and I would draw a trend line across there. Now traditionally, you will get 3 bounces off of an RSI trend line. More often than not, the 4th attempt will will break through instead of bouncing. This isn't always the case, but usually you will see a bounce. Alright, so let's see how this works out then. If we play this chart forward, you can see that RSI is coming out of the oversold region, and we have found support off of the contract lows. A couple sessions later, we're trading near the 50% level, and we are also at an RSI test point. We are intersecting our trend line. Now from here, I would expect the market either to bounce off of it or to break through higher. And depending how the market responds to this test point, I will plan my trade accordingly. So the next couple of sessions, you can see that the RSI actually hooked lower. So this is already telling me that I should be in a position to sell this market short. And I'm going to short that bar right there. I'm going to sell the low of this bar. The indicator is already heading lower, but prices have not yet responded. This is probably one of the reasons I like using RSI, because every once in a while it will move ahead of prices. Not always, but sometimes it will actually move before prices move. Next couple of sessions after that are rather quiet, and then we get this big move lower. And you will see this happen time and again. Now, the way RSI has formed here, this is actually our third bounce, and as such, I would probably expect the market to continue lower, or at least the indicator to continue lower. It is important to note that the movement on the indicator has no correlation at all to what's happening in the price bars. You can see we had a relatively small move in the indicator and yet a big move on the price bar. And occasionally you'll get the opposite. You'll get a really big move on the indicator and just a tiny little move on the price bar. So just because RSI has not moved a whole lot, that doesn't mean that we can't ignore this old support down here on the contract lows. We still have to take old support and resistance into account regardless of what our secondary indicator is telling us. Because for all the good they do in helping us find the best place to get into a market, they are all lagging indicators, including RSI. It will never, or very rarely will it predict. As I mentioned in this example, it actually showed us that the market was intending to head lower before prices actually fell off. But it's important to remember that all indicators are nothing more than mathematical algorithms, and they have no predictive nature of their own. But having said that, RSI proves itself to be a very useful timing tool and certainly something that's worth adding to your trading arsenal.